Good morning, everyone, and welcome back for our 16th episode of Equity Explorer. I'm Karina, a global equity investment specialist at Fairtree, and I'll be moderating our discussion today. So, just to give you guys some insights on what Equity Explorer is, it was designed as a teach-in on key themes in equity markets, basically to offer some deeper insights into industries, companies, and trends that are shaping global investments. So, our goal here is to give you the tools to better understand the forces that are driving the markets and to highlight potential opportunities. However, please note that this is not financial advice, nor does it represent a deep dive into our portfolios. In the presentation, please feel free to send through as many questions as possible, and we'll try to answer them at the end. Just onto the next slide. Our global equity team believes there's no substitute for being on the ground. Given we run global funds, we really do prioritize traveling to these different countries. Just over the last 6 months, the team has visited 4 continents, over 10 conferences covering over around 300 meetings. This is from New York and London to Las Vegas and on to Mumbai, Delhi, Shenzhen, and Shanghai. So today's session is a special edition. We will have Jacques and Adam joining us, where they'll share their on-the-ground insights from their recent visits to both India and China. And the travel also doesn't stop there. Our next session will be handed over to Christoph Timbenkosi and Yanku. They've just returned from the US, so they'll unpack what they took away from those conferences. With that, I'd like to hand over to Jacques and Adam. They'll take us through today's deep dive. Guys, over to you.
Good morning, everyone. Thank you for joining us and taking the time to listen and join the call. We structured the presentation in a few segments to kind of give you guys a high-level overview with some topics we'd like to highlight or what we saw on the ground from the different industries, property, capital allocation. So let's get started and run through it. Maybe just to set the scene on our travels, the MSCI Emerging Market Index have performed very strongly this year. As you would know, it's given back some of its gains in July, but to the end of June, the index was up 24% in dollars. And I think what's been fascinating about this year is how narrow the market rally's been. The chart on the left shows that it was essentially just driven by South Korea and Taiwan. They've accounted for more than 100% of the performance. And the other big markets like China and India have faced very different set of challenges. India is one of the world's largest energy importers, so they remain sensitive to higher oil prices, while elevated valuations have also weighed on investor sentiment. And China has, of course, continued to grapple with the prolonged property market downturn, intense competition in the e-commerce space, weak consumer spending, and that's contributed to weaker earnings expectations and more subdued market performance. But we think this will turn at some stage. So it was good to be on the ground there, kicking the tires and getting to know the different business models, meeting with management teams to be ready for when it turns. Maybe just to further highlight how extreme this narrow rally has been, the chart on the right shows that for this year, only 18% of companies have outperformed the index. It just, again, highlights how narrow the market breadth and how low the market breadth has been. And of course, the strength of the South Korean and Taiwan market reflects a broader shift that we've seen in emerging markets. The traditional view of emerging markets being commodity-driven, capital-intensive asset class no longer holds. Over the past 2 decades, the benchmark has transformed, moving away from mining and commodities towards technology, e-commerce, and services. And this transformation is most evident at the country level. Brazil, South Africa, and Russia used to be about 30% of the benchmark 15 years ago, and that's declined to single-digit contribution to the benchmark. And in their place, East Asia has increasingly become dominant. Taiwan and South Korea now accounts for more than half of the index, from around 23 to 25% not that long ago. So with that, to kind of set the scene, India is one of the world's largest energy importers, as I mentioned. So their market have derated quite a bit over the past year. And they're also seen as an AI loser. So the chart on the right shows the forward PE graphs of top Tata Consulting, Infosys, which is two of the biggest consulting businesses. And you can see how those businesses have derated, similar to Accenture in the US, as they're seen as AI losers. So we had the opportunity to meet with these management teams to understand what's going on the ground, and understand the prospects of this business. And you can see how that market's derated. And similar with China, as they continue to grapple with a prolonged property downturn and the intense competition, we can see how that market has turned down. Looking at the high level macro, these economies are still growing very strongly. Over the past 10 years, India's grown at 6.5%, China's done about 5%, so India's growing at 1.5 percentage points above China. So still very strong growth being delivered from these economies. And if we look at the GDP per capita trends, the graph shows the GDP per capita in dollars over the past 35 years, and you can see how the GDP per capita of China has continued to increase to where it's in line with the world at the moment. But this chart highlights the long runway for growth still in India. India's GDP per capita is around $2,800, so still substantially below other EM countries like Brazil and South Africa, and of course China and the rest of the world. So still a very long runway for growth in terms of GDP per capita. And the median GDP per capita is also a lot lower than that number. There's some very wealthy pockets of people there, and also some very poor people. Around 800 million people are still living on food stamps in a country with a population of about 1.4 billion. So very long runway for growth for that market as they continue to grow.
Morning, everyone. So I just wanted to kick off by going into a bit more detail on the GDP growth trends in China. And where this is a busy slide, so we're not going to go through all the detail, but it's just a very interesting illustration. You can really see how, looking at how these key macro indicators have developed over the last decade, you just can see from the directional arrows on the right there, how pretty much across the board, with the exception of two, you've had a weakening trend over the last decade. So just showing how we are seeing decelerating momentum in the Chinese economy. This is partly due to the law of large numbers, as Jacques just showed on GDP per capita. You can see how a very strong growth story has played out. So you've got a much higher base than India. But there are also some kind of cyclical and possibly structural headwinds that are also impacting the economy, which we'll go through in a bit more detail. And then one of those key, I think it's both it's a headwind for China and a tailwind for India, is the demographic profile. So it's a very interesting contrast. You can see how China on the left, that's where you can see the demographic bulge is much more around the middle-aged population. So 40 to 60-year-olds is where the majority of your population is. Where on the right-hand side, you can see with India, a much younger population, the bulge more around 10 to 30 years. So that's going to be an important tailwind for India. You're likely to have much stronger consumption growth coming off that base, whereas opposite for China. So I think that has been a key factor driving this divergence in GDP growth trends, and also goes a long way to explain the valuation differential with India having this growth premium relative to China because of the demographic outlook. And you can see how this is translated into the trend in Chinese retail sales. So very interesting to see this kind of steady decline since the peak in 2007. So it's a very kind of sustained trend. And there's various factors for this. One is the demographics, which you just touched on. You then got weak consumer confidence, which I think is a reflection of the macro, and importantly, a consequence of the property market, which we'll go into more detail. But a very interesting or important statistic is that at the peak of the property market, 70% of Chinese household wealth was invested in property, which just shows how overweight, when you compare that to the US, is a much more even exposure between property and investments. So this has been a key headwind in China. You've obviously had a lot of wealth destruction. Property prices have now declined 40% since the peak. So this has been a huge headwind to Chinese consumers. And that's what's driven this more conservative behavior. So a very well-known trend in China is how you've got these much higher savings. People are basically hoarding their savings rather than spending because of these factors. And that's been a key driver of this retail slowdown over time. That said, it was encouraging that we did, despite this weaker trend, I did come across some potentially interesting investment ideas. So, one company we met, which is very interesting, which is one of the sportswear brands in China. It's actually growing market share because it's got more of an affordability positioning. It's growing its earnings, and the stock is valued on 5 times PE and an 8% dividend yield with 40% of its market cap in cash. So we just want to show this as the interesting, maybe building on the valuation slide earlier, but just showing how, despite the weaker macro, we are coming across some very attractive, potentially attractive investment ideas, which are valuation driven, and which we'll be doing more work on after the trip. And then just building on some of the kind of headwinds in the economy, this is one of the most striking charts that I came across during the trips. On the left, this just shows the trend in Chinese consumer confidence. And you can see how low it still is, kind of still below the COVID levels, which is very interesting because in most of the world we've seen consumer confidence recover. And particularly striking is that yellow line, which is the employment confidence. You can just see how weak job confidence is in China. And this, I think, is both a reflection of two factors. I think one is just the weaker macro, but secondly, very important is the disruption of AI. We're seeing just change people on the ground is, I think AI trends are quite advanced in China. And it really is hurting confidence in terms of how people feel about the future and their job security. And then on the right-hand side, another concerning factor for China is the level of youth unemployment. So sitting at 15%, it has improved somewhat, but it remains very high. You can see the overall unemployment is 5%, so significantly higher for youth unemployment. And this really reflects weaker hiring trends. I think people who've got jobs tend to be a bit safer, but the issue is kind of at that entry level. And we think that's a sign of the weaker business confidence, and is another kind of key signal of the weaker macro environment in China.
Yeah, so maybe just following on from Adam's point on unemployment and touching on India. We had the opportunity, and maybe touching on the informal economy there, we had the opportunity to visit Dharavi, which is one of the 5 biggest slums in the world, with more than 1 million people living in a 2 square kilometer radius. And Dharavi's economy is absolutely booming. It's highly resilient. Informal market is driven by around 15 to 20,000 single room micro enterprises. And it's estimated that they generate somewhere between $1 and $2 billion per annum from 4 main industries. There's leather manufacturing and textile manufacturing, which is shown by the photo on the left, pottery, and then also very large scale waste and plastic recycling. And so getting back to unemployment, the graph on the left shows the unemployment rate. It's been around 7.7%. You can of course see the COVID drop there and the pickup, and then it's steadily decreased to around 4.2% at the moment. So the unemployment rate is very low. Now, part of that decrease reflects a change in how India measured unemployment to capture more of the self-employment and work done in the informal economy. But there was a lot of people working at our hotels as well, so unemployment is very low, and that's reflected in the stats and that big informal economy. And then high level, in terms of ideas, India as a whole is still trading at elevated valuations, as we showed earlier, to emerging markets. So you need to be very selective. As an example, the graph shows the forward price earnings of Colgate in orange and Maruti Suzuki in black, both companies we had the opportunity to meet with, including some other auto companies as well. And if you think about the positive demographics that Adam mentioned and the low GDP per capita, This gives discretionary spending in India a very long runway for growth. Uh, but despite this, discretionary stocks are still trading at around half the rating of staples, and the market is paying big premiums for staples. So this gives you a flavor of how selective you need to be in the market. Some of those bigger consulting and banking stocks have decreased, but a lot of the mid-caps space, the stocks are still quite expensive. So then moving on to manufacturing, infrastructure.
Yeah, we just wanted to, I think it's a very interesting contrast between China and India. So just wanted to start with showing some photos. This is from being on the ground, just showing the quality of rail infrastructure in China. So on the left, this is a high-speed train during my 2-week trip. Obviously, they included the weekend, so I got to have some personal time out just to do some exploring. And I did a very interesting day trip from Shanghai to Suzhou, which is a city around 100 kilometers away from Shanghai. And this 100-kilometer trip, took only 25 minutes on this train, which is incredibly impressive. The top speed was 290 kilometers per hour. They actually go faster than some of the longer routes. But just showing just the very high quality of the rail infrastructure. And on the right, this is just an information board from the Shanghai Metro. And what's that show? That's showing you the expected arrival time of the train, and that is to the second. And the train literally did arrive to the second. So just showing the precision and the quality of Chinese engineering. And very interesting, even on the bottom, that bottom green bar, that's actually showing the occupancy level of each carriage in the oncoming train. So just the most phenomenal data precision that you see in China. I thought that was very striking. And then secondly, just looking at some of the urban infrastructure. So these are 2 photos from Shenzhen, which is where I started my trip, which I was really, really impressed with the city. This is kind of considered the kind of new growth city of China. It's a fascinating history. Back in the 1980s, this was a mere fishing village, and it's now grown to become the 3rd largest city in China. It's home to 20 million people. It's also home to many of the leading technology companies, including Tencent. So hence it's regarded as a Silicon Valley of China. And on the left, that is the Ping'an Finance Center. It's the 5th largest or 5th highest building in the world. Goes to 600 meters. And you can see on this day it dramatically even went into the clouds, which made for a good picture and just highlights the scale of these buildings. And on the right, that's a lovely bird's eye view from the top of the skyscraper, and what you're looking out over the city center. And it just shows the quality of urban planning and design, especially being a newer city in China. So just the beautiful, abundant green space. The one on the Sunday morning, I went for a beautiful jog around this area. It was really a fantastic experience. And that's the civic center in the middle, which also shows this beautiful futuristic architecture. So just a very striking illustration of the quality of urban planning and infrastructure in China.
And then to contrast that to what we saw on the ground in India, of course, India is also developing very, very quickly at the moment. Large parts of Mumbai, there was nothing just 15, 20 years ago. And this photo at the top shows the Ambani retail center, very high-end retail center with all the luxury brands in it. So there is big infrastructure development happening there as well, but the pace of the infrastructure development hasn't really kept up with how quickly the economy is growing. The photo on the left there shows just how hectic the traffic is. There'd sometimes be 5 cars side by side in a 3-car lane. So the infrastructure development in terms of roads and bridges haven't really kept up. Bengaluru specifically was very bad. Our hotel was 40 kilometers from the airport, and it took us more than an hour and a half to get there. And some of the companies we met with, some of the employees stay less than 3 kilometers from the office, and some days it takes them more than an hour to get there if they drive. So the traffic is very, very bad. But this photo on the left shows how the government is addressing this, putting in trains and building out the rail network In Bengaluru, for example, high-speed train, they're building from the airport into the city center and throughout the city as well to ease the congestion and help that and help the traffic improve. But we think there's still quite a long runway for growth for them to continue building and improving the infrastructure.
Cool. And then we also wanted to talk a bit about manufacturing, and there's various ways of illustrating this in China, but we just thought it was most helpful to illustrate through what's happening in the electric vehicle market, which is such a topical sector globally. And just to start off with, this is an example of just the high quality of local EV brands, which is a key positive impression from a time on the ground. So this is a brand called Exceed, which is a premium brand produced by Chery, which is one of the leading local producers. And it was just what was very interesting is the abundance of EVs. So it wasn't just the quality, it was also the quantity. And being on the ground in Shenzhen and Shanghai, the vast majority of cars were EVs. It's not just 5-10%, it's probably 80-90% of the cars were EVs, which just shows how advanced this is in China. And it was very added to a very positive experience. You find your urban environment a much quieter, obviously less pollution. So you can really see the benefit of EVs when you're on the ground in China. And you can just see how this is played out. This is a very interesting chart just showing the overall, this is for the overall Chinese auto market, just the trend in market share by brand nationality. And there you can just see how this structural advance in the market share of the domestic brands. So, it's roughly 10 years ago, their share was 30%. That's now doubled to 60%. So fascinating to just see how these local brands are taking over in China. And you can see how the biggest loser has been the US brands, which is interesting from a geopolitical perspective. And then also interesting to note the specific share of Tesla. Obviously, we see in most kind of Western markets, you see Tesla having a very strong share, particularly within EVs. But you can just see here how in China, they obviously had this strong start, but how their share has plateaued versus the gain in the local brands. So I think this just shows how in a market such as China, I think Tesla had this first mover advantage, but now you can see how the competitors have caught up and are actually outcompeting them, which is very interesting from a Tesla perspective.
It also highlights how important it is to travel to other parts of the world. You can't just look at Tesla in isolation, because the products the Chinese are producing are exceptional quality and great value for money. So nice insights for the global equity fund as well, not just for EM.
And then another key factor with the Chinese auto market, not just what's happening domestically, but also from an export perspective. So this is a very interesting chart. It just shows the trend in export volumes for the Chinese producers and how this has increased, sevenfold from 1 million units to 8 million units since 2020. And this is being driven by the improving quality, as we've seen in the earlier photo. And it's just a very interesting, one of the big themes of the trip was the amount of capacity that's being produced in China. And it's very interesting how the government's strategic focus is to stimulate the economy through manufacturing rather than consumption. And there's a lot of debate in the market about whether that's the right approach. But it's very interesting how you see this playing out in the auto market. So just a very interesting statistic is that in China, the current production capacity of the auto industry is 60 million cars per year. This is 2/3 of total global production. So it just shows how much capacity is being built up in China. That's roughly double the local demand is close to 30 million units. So you can really see how China is really positioning very strongly for export growth through the auto industry. And it's going to be interesting to see how that plays out from a geopolitical perspective, because when we see this in the markets such as South Africa, we see more and more of these Chinese brands popping up. And you can see from this chart and these numbers illustrates why, and why that trend is going to continue and become an even bigger trend in the future as China is looking to drive its economic growth more through exports than through consumption.
And this graph on the right, just before we get to the Indian manufacturing, it shows the installation of installed industrial robots in China. You can just see how far ahead China is, to highlight Adam's point, in terms of the rest of the world. But manufacturing is also an opportunity for India, given the China plus one move. So as I mentioned, you can see how far ahead China is, but it also shows the opportunity for India to catch up. India has typically been a services exporter with their consultants, but there's been a big push from government to grow the manufacturing export as well. The government aims to increase manufacturing's sector's share of GDP to around 25%. It's currently at around 13.5%, and they're looking to do this through measures like easing foreign direct investment norms. The picture here shows Maruti Suzuki's EV. So we had the opportunity to meet with them, as I mentioned, and again, they are positioning themselves also in the auto market for exports, where the government's Made in India initiative, they're looking to capitalize on that, where they work with Suzuki on the IP, but then the manufacturing happens in India, and the exports is then from India. So there's big investments going into the Indian economy as well, and they should benefit from this China plus one move. Sorry.
Cool. And then we just want to talk about the property markets and the differences between the two. I mean, the Chinese property market is a very hotly debated issue, especially as we've shown earlier how it's such a key driver of the economy and has been this key headwind. So it is interesting how you see a lot of external commentators, particularly, I think, talking about a possible, stabilization or recovery in the Chinese market. And I think that's more just due to a time factor, on the basis that we're so far into this downturn, and surely it should start to stabilize. But a very interesting insight from being on the ground was how the local commentators and experts were actually more cautious, which I thought was a very interesting and important insight, because it's going to be a very key driver of the economy from here. And the reasons for this caution was the demographics, which we've highlighted. Obviously, you've got aging demographics. That logically means less demand for housing going forward, and it's obviously opposite in India. Secondly, there's unfavorable economics despite the downturn. Rental yields are still below mortgage rates in China, so that remains a key issue. And then thirdly, excess supply. This photo on the right is just a helpful illustration of how abundant property supply is in China. This is a very common scene that you see. This was actually taken from the train. And you can just see how the kind of vast amount of these high-rise apartment blocks. So just an interesting stat was the current unsold inventory in China is equivalent to 6 years worth of supply. So it's, despite being 5 years into the downturn, we're still sitting on, China is still sitting on this amount of excess inventory. So it's taking a long time to work through, which really reflects the weak demand environment. So I think that was just a key takeaway, that, I think to have cautious expectations around the Chinese property market, despite being so far into the downturn.
And then maybe just to touch on the Indian property market. Property in Mumbai is very expensive. There is, of course, very limited land capacity in Mumbai. So the properties there are very expensive. They range anything from 15,000 rupees per square feet to 120,000 rupees per square feet, depending on the location and the luxury tier. But the citywide average hovers around 38,000 rupees per square feet. So that equates to 72,000 Rand per square meter. And that seems very high if you think about a country with an average GDP per capita of $2,800, which is basically a third of SA. And what's interesting, and the dynamics of the property market at the moment, is the big slum redevelopment. So there's still a very large portion of India's population that lives in slums. And those slums are being redeveloped. And how that works practically is that a developer would approach the people living in the slum. They would pay them around 20,000 rupees per month to move out of the slum and rent an apartment of equivalent value. And to just put that into context, a good salary from the people we spoke to on the ground is around 45,000 rupees. So there's a big incentive for people to move out. You get a 50% bump. And you can rent an apartment of equivalent value, or you can move into another slum, which seems what they typically do. The property developer would then redevelop the area. They would build a building for the people that used to live there, and they'd give them the apartment for free at the end of the 5 or 10 years, or however long it takes to build the building. But then they'd also build 2 or 3 new buildings on the site. And by selling those apartments, that's how they make their profit. And there's a big incentive for people to do this, not only for money, but you get a much nicer living experience moving back into the buildings that the developers have built. It's around 275 square feet with 2 bedrooms and a bathroom, versus people living in the slums. Typically, hundreds of people share the same facilities. So there's a big upgrade in lifestyle as the people then move back into the redevelopment areas. And the properties that are developed is typically worth, for the people in the slum, around 600,000 rand that they get at the end. But the flats being sold is probably closer to something like 3 million rand. So that's where the property developers make their money. But the prices being that high that I've mentioned earlier means that the rental yields they are very low. So the rental yields are between 2 to 3%, which seems very low if you think about a cap rate of around 7 to 8%. Office yields are much closer to that. But we think there is still scope for the property development to continue there. People want to own more homes. There's still families living together. So as the general economy gets richer and your GDP per capita grows, people will buy more homes. And people still only own one home, which is different to the Chinese property cycle that we saw, where people own 4 or 5 flats and started speculating in the property market. Like Adam mentioned, and we've seen the downturn from there. So we don't think we're close to that at the moment. There is still a lot of runway for property to grow, but eventually those low rental yields would need to normalize sometime in the future.
Great. Then we just want to speak briefly on capital allocation. So this was one of the key positive takeaways from my China trip. And you can just see this chart just shows how we've seen a steady improvement in dividend returns, both in absolute terms and also the dividend payout ratio. So you can see over the last decade how that payout ratio has doubled from 20% to 40%. And this is a very interesting regional theme. So there's 3 markets, China, Korea, and Japan, where you all see this theme of improving corporate governance, which also translates into more shareholder-friendly capital allocation. So that's a really key positive we see playing out across all 3 of these markets. And it's a very interesting trend of my company meetings. Obviously, I think met over 30 companies during the trip, and it was a very consistent theme, how they were almost across the board improving their payout ratios, and talk about steady kind of ongoing increases in that payout ratio. So we just think that's a key positive theme across emerging markets, particularly in Asia, how you are seeing this improving capital allocation, which translates into better cash returns and possible re-ratings in the valuations as that gets rewarded by the market.
And then I'd like to touch on India's household capital allocation. We found that very interesting. India, on a household level, invests a lot of money into gold. It's seen as a key investment vehicle for them. Typically, when a couple has a daughter, they already start saving for in gold and buying gold for the daughter, because once your daughter gets married, that gold then gets passed on to her and to her family. So it's seen as a key investment vehicle for them. Um, and what I found interesting is how regional the brands are and the designs as well. So you've got some national retailers, but there's a lot of like regional retailers as well. And the formal retail in gold is still only about 40%. So there's big runway for the gold retailers to continue growing and taking share. Um, and what we found very interesting was how accurately uh, they disclose the amount of gold and break down the price. So in the shop there's a ticker going similar to an old stock exchange where they show you the carat of gold and the exact price at that moment, and whatever you buy gets weighed there. The quality gets tested, and they show you the breakdown between the gold and the labor component. So I thought that was very interesting. And then, of course, India is one of the world's biggest importers of gold. And what's happened with the oil price and the need for them to import oil has meant that their current account has been under pressure. So there's been a government incentive for um, so the government has actually tried to stop gold imports, but the retailers have also responded, where if you bring your old gold jewelry, they would actually give you the exact spot price there to trade that in if you want to buy a new piece. And it used to be that you can only take it to the same retailer or company, but now it's opened up even more. So that we thought was quite interesting, and it's almost a natural hedge to the gold there. Um, but yeah, fascinating dynamic in terms of investment vehicle. And it also means that given how the share price or the gold price have run, that the NAVs that the households are sitting on has also increased substantially if you think about 5 years ago, because you've got all this gold sitting in households that's not being marketed to market. And typically, even if you have gold savings and you want to buy a car, people won't sell their gold. They keep their gold for generations and it's passed on. They would typically take a gold loan against it, and then pay off the gold loan rather than selling the gold. So it just gives you a flavor of how important it is to their culture, and how important it is as an investment vehicle for them.
Great. Then we just wanted to finish the presentation by sharing some of our on-the-ground experiences. Um, so this just shows how when we travel, we really do like to roll up our sleeves and get properly on the ground and get out with the locals and just experience what it is like to live in these markets, especially where it's culturally so different. You get so much insight from these kind of experiences. And this just shows a very interesting foodie experience that I had. I went out to a dumpling restaurant in Shanghai. And firstly, just on the left, you can just see that it's very much a kind of no frills experience. So it was properly local. Wasn't any kind of fine dining as such, but the food was delicious. It was also very well priced. I mean, this meal came to around 100 Rand. So it just shows, I think, how it's similar to, say, getting a takeaway meal in South Africa. And just also to flag that chap in the bright yellow, that's a Meituan delivery driver. And this was also very interesting. You just see an abundance of food delivery in China. Um, and just on the and just it was interesting on the right. I mean, that was just a very striking picture, seeing all these just a row of solo diners, which wasn't typical of all restaurants, but it's just very striking in this restaurant. And it's partly cultural. I think this is a lot of people, because of it's so affordable, this will be their kind of dinner on the way home. So just for the convenience factor, they'll pop in. You can see a lot of them in their working clothes, just popping on the way home. It was right near the metro station, so it had that convenience. But I think it also might be an interesting reflection of demographics in China. We obviously know there's a lot of singles, with the single child policy, people are actually used to kind of more of a solo lifestyle. So it's possibly both cultural and a demographic insight that I got from being in this restaurant. And then last from me is just to share some of the tourism highlights just from having some personal time out. And on the left, that is a beautiful picture from Suzhou, which I mentioned earlier. That's where I went on the high-speed train. This is a very beautiful historic town or city. This is the more of like the old historic part of the town or the city. And it's called the Venice of the East because of this beautiful this canal layout, and there you can see the local version of the gondola um, in China. And so that was just a very lovely experience. What was also a very interesting insight is I was there on a Sunday. It was absolutely heaving with tourists, but importantly, those were 98% locals. So it just shows two things. One, how domestic tourism is really a strong area of growth. In China, actually, one of the most positive meetings was with a hotel company, which another possible investment they will do more work on. So it just shows how there is these pockets of growth with despite the kind of weaker macro backdrop. So we're looking out for those. And secondly, it just shows, I think, how China is still very undervisited by Westerners. I know that's something that they actually really want to encourage because I think a lot of the sense is that some of this geopolitical tension comes about through lack of understanding. And going to somewhere like this, you realize it is culturally very different. So it really is important to visit these places to kind of create these cultural ties. So just an interesting insight into tourism. And on the right, that's just a really spectacular view from the top of the Shanghai Tower. This is the third highest skyscraper, so I had a good time going up tall buildings. So this is 630 meters high. Just the most spectacular nighttime view. I mean, you actually got to remember this is from a building. It almost looks like you're from a plane or a helicopter, but just so incredible to see how high that is. And also just shows this very futuristic skyline of Shanghai. And Shanghai is a real reflection of the vibrancy in China and just its kind of ambitions for the future.
And then just our experience in India, what we found interesting was, especially at the Western hotels, how expensive the stuff still felt, especially relative to India. I had the opportunity to visit to China. Sorry, I had the opportunity to visit China last year, and India felt quite expensive, despite this devaluation, the sharp devaluation we've seen in the currency. It still felt quite expensive on the ground. Food was very expensive at the Western hotels. It was actually quite reasonable at some of the local restaurants, and it was very cheap on the street. So for locals, I think it's reasonable, but at Western hotels it was very expensive. And then alcohol was extremely expensive at the Western hotels, and also at the restaurants. It's of course driven by very high taxes on alcohol. And the taxes vary between the regions as well. Mumbai, it's very high. And just kind of give you guys a flavor of how expensive it is. That's a bottle of Wolf Trap we saw on the menu at one of the restaurants, and that's 1,000 rand for that bottle of wine, which typically retails in SA for somewhere between 70 to 80 rand. So it gives you a flavor of how expensive eating out at some of the Western hotels, and specifically alcohol, is. Even the local beers and so on is quite expensive. And then just some tourism highlights from our trip. I'd firstly not recommend going in June. It was very expensive, very hot. Mumbai was 35, 38 degrees with 80% humidity, so it was absolutely insane. So rather go in January if you're planning a trip. But on the ground, it was the locals were very friendly. You feel super safe everywhere you go. You see very few beggars, despite the big poverty and people living in slums right next to some of the richer areas. You see very few beggars. Some other highlights: the clothes and the jewelry design and the food, and the food is very regional, so you can't really place them in a box. They've got very different designs in terms of and food wherever you go. And then something that was quite a relief for me is that the food wasn't as spicy as I feared. The food was incredible. So that was quite a nice highlight to sample all of their different cuisines. And then just some photos from our trip to kind of give you guys a flavor. This is me and Cornelius at the Taj Mahal. And this is the the gateway to India, or as the locals call it, if you're a British citizen, get away from India. And this was Mahatma Gandhi's house that we had the opportunity to visit. This is just 3 photos. Elephanta Caves was also a very, very nice day trip. So yeah, it was a very fun experience over the weekends to also kind of get do some nice sightseeing and do a city tour and a slum tour. So that was very interesting. And with that, that concludes our presentation. So happy to open it up for any questions on the line.
Fantastic. Thank you guys so much for those brilliant insights on China and India. Let's get going with some questions that have come through. So first one, what has caused the divergence in GDP growth between India and China since 2020? And what is the outlook from here?
You want to take that one?
Yeah, I'll take that. I think it's largely, hopefully illustrate that. I think a big reason, particularly as the move since 2020, you can see the impact of the property market, because obviously we've shown how property was performing fine until 2021. So I think it really is, that's probably the biggest, call it cyclical impact. Whereas obviously that market's been a lot more robust in India. And then I think also the demographics, that's probably more of a gradual effect, but I think that's also impacting the growth. I would also say that GDP per capita, as we showed, it's much more advanced. It's really kind of played out a lot more in China than it has in India. And then I think also, yeah, just some of these cyclical headwinds, particularly around the issue around consumer confidence and how that's leading to people, really hoarding and saving rather than spending. So I think it is. I think it's a good question. I think it's a combination of both these structural and cyclical headwinds that we're seeing in China relative to India.
Fantastic. Thanks, Adam. Next one, are you starting to come across more investable opportunities in India following the recent derating?
Yes, we are. I think you still need to be selective, like I mentioned. That mid-cap space is still trading at elevated valuations, but I think a lot of the banks are showing much better value. Their credit growth is still very robust. Credit loss ratios are 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 still very contained, and they've derated. So we're seeing some opportunities there. The consulting businesses is a tough question to answer on a longer term view. I think short term there's a lot of pessimism priced in to them because this AI transition won't happen overnight. A lot of the businesses there are still got legacy systems that need to be upgraded. So I think there's a lot of pessimism being priced in there, but whether they re-rate is another question. And yeah, we are seeing selective opportunities within their manufacturing capacity. For example, there's a company that we follow quite closely that manufactures cables and wires, and domestically they are growing very quickly. They're targeting 5% of their revenue to be from the export market, but they almost never get to that target because the domestic growth is so strong that the domestic growth is overshadowing the export market, even though exports are growing quite quickly. So there's selective opportunities that we're seeing that we will lean into as valuations continue to come down.
Great. Thank you, Jacques. And maybe just pivoting off that question, maybe you can delve into some of the differences between India and China as investment opportunities, just to close off.
Yeah, it's two very different markets, obviously at very different stages. So you need to be cognizant of what you're paying for the different businesses, and also the industry is right. There's still some banks that I don't think is really being run for shareholders, even though they're quite cheap. But then the banks in India look quite well placed. So I think you need to be very selective between the two markets. China, of course, needs consumer spending to increase. They really need consumer confidence to increase. So that's a trend we'll be watching quite closely. Um, yeah.
And just to maybe build on that is, yeah, I think it's selective for different reasons. I think India having to be more selective around valuations. China, as we've showed, is a lot more attractively valued, but I think there's higher risk of value traps in China, because you have much less of a tailwind. So I personally came away from China thinking it's much more of a stock pickers market going forward, which is good for an active manager. I don't think it's a market where it'd be as easy to make money just buying the index because you don't have that economic tailwind. So like that stock example I referred to, I did come away very encouraged. I presented the team like quite a few stock ideas that came out of the trip. So I think that's what's encouraging on a market such as China. I think it is unloved, it's undervalued, but you do have to be very selective because there are challenges in the economy as we've shown. So you've really got to be very selective. And it really is a stock pickers market.
Brilliant. Jacques, Adam, thank you so, so much for the presentation. I think we will call it there. And thank you to the audience for the engagement and the questions. If there are any further questions or you'd like to continue the conversation, feel free to reach out to us. And yeah, thank you again for joining. We'll be having our next session on the 13th of August. In that session, we'll get feedback from our analysts who recently returned from the US. So I think another exciting session lined up. But yeah, thank you so much, everyone, and chat to you soon.
Thank you.
Thanks,
Bye-bye.
everyone. Bye bye.
Yeah.